Welcome to the learning unit dealing with the disposal of non-current assets. Our objectives for this learning unit are to calculate and record the total depreciation for a scrapped, sold or traded in depreciable non-current asset. To calculate profit or loss on the disposal of the non-current asset, and lastly to record the entries for the disposal of the non-current asset. You can dispose of an asset in a variety of ways. The simplest one being selling it for cash. You're just selling the asset for cash and there's no other complication. You could also sell it on credit, you could trade it in, or you could also scrap it or donate it. For the scrapping or donation, you would find that there is no receipt of anything. So we won't receive money, or we won't have a debt, we won't have a debtor sitting on our books, and we won't have a corresponding asset as well. It is very important when you start to record the disposals to follow a set of steps. We've got 5, and I would encourage you to know these 5 very, very well. Step number 1 is to bring into account the additional depreciation for the asset that is sold. This occurs if the asset is sold either at any time in the year except for at the beginning of the financial year. So if it's sold in the middle of the year or even at the end of the year, you have to bring into account the additional depreciation. We then transfer the total accumulated depreciation, which is whatever the accumulated depreciation was at the beginning of the year, plus the depreciation that we've brought into account in step number 1. Then we transfer the cost price of the asset from the asset account to the asset realization account. We record the proceeds and then we calculate the profit and loss. Just going back to the proceeds, if the asset was sold for cash, the proceeds would be debit bank, credit asset realization. If it was sold on credit, then it would be debit debtors control, credit asset realization. If, for example, we've given it as a donation, then the debit would most likely sit then in the donations account and the credit would still sit in the asset realization account. So let us do a practical example. In this example, we are given a trial balances at the beginning of the financial year, which is the 1st of March 2009. We've got vehicles in our books for the total value of 280,000 with an accumulated depreciation on vehicle of 80,000. We're told that depreciation is calculated at 10% per annum on the diminishing balance method, and our year end is the 28th of February. On the 1st of September 2009, we traded in a vehicle with a cost of 75,000 and an accumulated depreciation of 25,000 on the 1st of March for a value of 55,000 in return for a vehicle with a cost of 80,000, and that was on credit. Our required is to record all the journal entries on the 1st of September 2009. So normally the first thing I would start with would be the calculation. And the first calculation, which is the simplest one, is to calculate the extra depreciation on the sold vehicle. The sold vehicle had a cost price of 75,000, and from the 75,000 we took away the accumulated depreciation of 25,000, multiplied by 10% and multiplied by 6/12 because we sold it on the 1st of March. So it's from on the 1st of September. So it's from March, April, May, June, July, August. Then we'll have 6 months. That will then give us a depreciation of 2,500. Then we need to calculate the accumulated depreciation on the sold vehicle because we need to move all the accumulated depreciation. That is simple. It's the 25,000 rand at the beginning of the year plus the 2,500 that we've just calculated. That will give us an accumulated depreciation of actually 27,500. There's an error there. Then we calculate our profit or loss on the sale of the asset. We start off with our proceeds. We are told that we traded in for a value of 55,000. Then we take away our carrying value, which is our 75,000, minus the 27,500, not only 25,000, which will give us a carrying value of 47,500. That gives us our profit on sale of the asset of 7,500. Then if we then look at the journal entries following those 5 steps. Step number 1 is to bring in the extra depreciation. You would debit depreciation with 2,500. You would credit the accumulated depreciation on vehicles with 2,500. The next step is to then move all the accumulated depreciation of the sold vehicle to asset realization. So you debit accumulated depreciation on vehicles with 27,500 and you credit your asset realization with 27,500. Step number 3 is to then move the cost of the asset from the asset account to asset realization. So we debit asset realization with 75,000 Rand, which is the cost of the asset, and we credit vehicles with 75,000 Rand. Step number 4 is then to record the proceeds. In this case, we traded in the vehicle, but we also got another vehicle on credit. So our debit will be in the creditor's control for 55,000 and our credit will be in the asset realization account. And then finally we calculate the profit and loss, and we calculated it and we got 7,500, which was a profit. So to record that, we debit asset realization with 7,500 and we credit our profit on sale of asset with 7,500. The one entry which I'm not showing here is then, because it would also occur on the 1st of September, is to bring into our books the new vehicle that we have acquired, that one costing 80,000 Rand. So we would debit vehicles for 80,000 Rand and we would credit our creditor's control for 80,000 Rand.